Hello and welcome. My name is Suli Richardson and I am the Community Education Program Manager at Desert Financial, and I am excited today to be able to present this webinar on understanding the basics of credit. So we're going to be learning about understanding that whole credit reporting system. We're going to talk about the credit score, how to improve the score, what makes up the score. We're going to actually take a look at a sample credit report. We're going to talk about the different types of organizations, companies that want to look at our credit file. We're also going to talk about repairing credit that has been damaged, plus a whole lot more. Credit is a big part of our society. We need it to get things like buying a house or a vehicle. Those are common expected reasons why people get loans. Using credit cards to finance our entertainment, our vacation, our trips, buying clothes, getting food, those are ways when we use credit and we use credit cards to finance those types of items, they get us into trouble. If we're using our credit cards to finance our trips and our clothes and vacations and we don't pay it off in full, in essence, we are borrowing money for non-essential expenses. So there is good use of credit, and then there is unhealthy use of credit. So I just want to speak briefly to the definition of credit. It is the ability to obtain goods and or services before payment. The principal is the amount of money that you borrow, and the interest is the additional amount that you pay the lender. So interest on loans accrue daily. So as you are making your payments, the lender will usually always take whatever you owe to interest first. So every day that you have an outstanding balance, the interest accrues on that loan daily, every single day. And this is good to know, especially for those of us who are trying to pay down and pay off debt quickly and sooner. It's good to know how the interest is calculated, because then it helps us to understand how we can get that done easier. And so I will talk more to that a little bit later on. There is a prerequisite for using credit, even though many people might not put this into practice. In an ideal world, it would be great if we worked from a spending plan, worked from a budget, and we had an adequate emergency fund so that if something should happen, we would have some money, not if, but when that bad thing happened and it takes some funds, that we've got some money sitting in an account that we can use to help us to get through that situation. Having that written spending plan will let us know how much of our income is safe to spend on credit. When you are working from that budget, you would know. There's no guessing about it. Sometimes people get loans because, of course, they need it, but they feel like they can afford it. One of the things that I've been telling people is that if you think you want to get a loan and you feel like you can handle it, try making that payment to yourself. Make that payment to yourself for a few months and see what it feels like. Do it for a few months, see what it feels like. If you feel no pains from any of that, then run with it. But if you're struggling and you're making that payment and it's not comfortable, then maybe now is not the right time to get that loan. And so the other reason also on why you'd want to have an emergency fund, an adequate emergency fund, is that if you should have a loss of income, decrease in hours, your income is cut, you don't have a job any longer, you want to have some money that you can live off to help you still pay your rent, pay your mortgage, pay for your living expenses, in addition to paying for your loan so that you can protect your credit history. The Truth in Lending Disclosure Act, TILA, is what we call it. This is a law that requires lenders to disclose the terms and the cost of a loan. This is very likely familiar to you if you have applied for loans in the past or you have them right now. So sometimes we're so excited when we get approved by a loan that we don't pay attention to these details. We don't know what the annual percentage rate is, the finance charge, the amount financed, because we're excited. We don't know how many payments, how long the term is. the monthly fees, if there's any, the payments. We might know what the payment is, but some of this other stuff, sometimes people just don't know because they're excited and they don't pay close attention to the details. When you are signing up on that loan document and the loan has been finalized, the note and disclosure is where the lender would go over these items with you. Some of these are even negotiable. I might want to pay my car off in a 4-year loan and not do a 5-year loan. That is one of those things that might be negotiable. So as a consumer, fully understanding the impact of all of these terms will help me understand whether I'm in a good loan or not, whether the loan is adequately what I need. Fully understanding how these will impact me puts me in the driver's seat and in control over my finances. So there are 2 types of credit that we're going to be discussing. The first is the secure loan, and then we have the unsecured loan. The secure loan is secured by the item that's being financed, which would be the vehicle or the house. So you really don't fully own these items until you have paid them off, and then the lender gives you your deed. They release the lien hold from the title, and now the title no longer reflects their name as being a lien holder. So you really don't own it until you've made that last payment and the lender's name is removed. And then we have the unsecured loan, and credit cards are one of the most common types of revolving credit, which is an unsecured loan. And then we also have the personal loan, which could also be a revolving line of credit. With credit cards and lines of credit, they are loans that you can borrow from again and again as the debt is paid down or paid off. You don't have to reapply for your credit cards every year. You don't have to reapply for your revolving lines of credit. As long as you use those credit cards and your lines of credit and you're making your payments, you typically never have to reapply again. And so there's also the personal loan, which could also be an unsecured loan, but it doesn't have a revolving credit line. So I might want a loan, a personal loan. It's $5,000. There's no collateral. It is just based on my application, my credit history, my report. And so I get this loan. It is $5,000. Once I have that loan and I make payments, and let's say I pay it off, if I need an additional $5,000, that means that I have to go in, or however I apply, I need to apply again for another loan. Unlike the revolving credit, I never have to reapply again. It is just always there for me to use anytime I want it. There is something to be said for having access to a revolving line of credit, something positive. So in class, when I'm teaching, I usually ask this question: does the Visa debit card and the Visa credit card both help you build credit? And usually I get a mixture of responses. Some people will say yes, and then others will say no. The correct answer is no. When you're using a Visa debit card, you're using your own money. You're using money that's in your account. The fact that it has the Visa logo just allows us to use either of these cards anywhere in the world where Visa is accepted. The Visa debit card, the Visa credit card, what they have in common also is that Visa offers zero fraud liability protection. Due to all the different payment options available on how we can use our card and transact and make purchases, there's a lot of risk and fraud that comes into that comes with that. Our information can get compromised. So Visa offers the zero fraud liability protection on both cards. And depending where you use your card, you might get a phone call from credit monitoring services provided by Visa that will ask you to verify certain transactions on your account if it looks a little bit unusual than what your normal pattern is. They will ask you to verify the amount of the transaction and maybe the store. What they will not ask you is to verify your social security number or your account number. Your financial institution already has that information. So if somebody is calling you and they're asking you for your social security number or your account number, it is more than likely a scam. So hang up and then call your financial institution. You never want to give out that information. We create our own credit file. We create our own credit reports based on how we handle our finances, our payment histories, etc. As we apply for different loan services and pay on our loans, we create our own credit file. Companies pull our credit report. Companies pull our credit file from the three major credit reporting agencies, from the three major credit bureaus: Equifax, Experian, and TransUnion. These credit bureaus are sometimes referred to as data warehouses. They store, they package, and they sell our information to companies with whom we want to do business or companies that want to do business with us. Our credit rating impacts our pocketbook. So this example of a car loan for $5,000 with a repayment over 5 years, the first rate is 7% with a payment of $99. And then you have another individual that's getting a 15% rate with a $119 per month payment. There's not too big of a spread when you look at the payment per month. Where you see the biggest difference would be in the finance charges. So when you take that rate and you do the calculation over the 5 years with the payments, this is where you see the difference. $940 versus $2,137. This is where you really see how much of a big impact that your credit rating, that your APR makes in your pocketbook. A lot of times when we shop for cars, and especially if you're going to the dealers and they're asking you questions about, what do you want your payment to be? That is something that should have already been worked out, maybe getting pre-approved first, so that when you go, you're just negotiating the price of the car. The term is negotiable. The rate, you want to shop rates to know what the going rate is for certain loan products. When you do that, it puts you in the driver's seat so that you can make an informed decision on what is best for you. So it is to our advantage to compare the rates and to compare terms when we are applying for any type of loan. So we know that financial institutions pull credit to help them make a decision in granting a loan. There are also other businesses that want to see our credit report and use that information to decision their applications. Companies like utility companies, employers, insurance companies, finance companies, landlords, lots of different organizations use credit reports to help them to make a decision. As a consumer, we should also want to see a copy of our credit reports. 1 in every 4 credit report, there was a study that was done that it said that 1 in every 4 credit report has some type of mistake, some type of error. There was something wrong. It could have been something as minor as the address is wrong. My name, well, that's not minor. My name being wrong, that's not minor. But it might seem like it's something minor. Whatever is on your report, even as insignificant as it may seem or appear, if it's wrong, it's wrong. And you really want to get that corrected, because it could be the determining factor on why you get denied for that loan. It could be somebody else's information that is co-merged with yours. So you want to make sure that all of your information is correct on your credit report. Lots of companies pull our credit report. They use information to make decisions. These are some of the examples of what could happen as a negative impact. So if my credit has been damaged, these are some of the consequences of what I could expect. Maybe I pay a higher insurance premium. for insurance. Maybe I'm denied employment. 60% of employers are checking credit to help them to make a decision on whether or not to hire a job candidate. You might be turned down for a cell phone, might not be able to lease an apartment, and you might have to even pay a higher utility deposit. So we have access to get a free copy of our credit report from annualcreditreport.com. This is the official website that was created some years ago by the Federal Trade Commission to give us consumers access to our credit reports. We get one free report every 12 months from all three of the credit bureaus. Because of COVID-19, right now, we can get one free credit report from all three of the credit reporting agencies every 2 weeks until April 2021. And so in order to do that, you will have to go through this website, annualcreditreport.com, and you can get that report. The credit report that you're going to get from this site does not give you the score. It's only going to give you the data. There are other internet offers. There are other marketing companies that advertise getting a free credit report. You have to know that anytime there is something that is created for us consumers that is good and legitimate, there's always going to be a person or a company that has a great idea that markets something that looks like it, smells like it, looks like it, acts like it, but it's not the legitimate site. So there are other companies out there that have been created that offer a service that give you a free credit report, but they're also going to try to sell you something. Credit monitoring services, or they might be partnering with multiple financial institutions or lending product companies to offer you loan products. So they're going to try to sell you something. So this is a sample of the report that we're going to look at today. This is from Experian. We will briefly look at some of the items on this report, only the things where you see the star. We're going to talk about those and address those areas. So you're pulling your report. At the top, you have your name. Here we've got John Q. Consumer. You get a report number, which is good to have, because if for some reason you have to refer back to this report because something's on it, and now you have to do some further work, investigation, follow up, you're going to need this report number. If you look down to the bottom, it says civil claim paid, the second star. This report has all the potentially negative items on the first page up front. It's a civil claim. It has been paid. It was an individual responsibility, and it's for $200. Even though this item has been paid, it still shows. Sometimes people think once they pay something off and it's been reported negative, and once they make that payment, it drops off. That is not the case. Negative information, especially things that have gone to collections, will be on your credit report for up to 7 years. Here we have a cable service that has now been turned over to collections. It was for $95. It was past due. It was an individual responsibility, individual account, and it went to collections, and the item is being disputed. Sometimes people are disputing items with companies. Maybe it's an error. Maybe they don't owe the money. If that is the case, you as a consumer, me as a consumer, we have the ability on that website to write a statement and dispute it so that others looking at my credit report will see that I am disputing this. If it is something minor that can be disputed by me just putting a statement, that's fine. If it is something where my identity has been stolen and now somebody is applying for unemployment in my name, I'm probably going to have to do a little bit more than just putting a statement on my credit report. Bad debt there's a big business for companies that buy bad debt. They're a company, that's their business. What they do is they buy bad debt for pennies on the dollar, and that's their business. And so they're going to try to collect that money any way that they can. So being a informed consumer will let us know what our rights are. It'll let us know what our options are when we're dealing with collection companies. Sometimes they are a little bit ruthless and they make things up. So the Federal Trade Commission, they not practice, but they put out reports on their website on all the different companies where they have entered into lawsuits on behalf of consumers, because there are a lot of companies that do not abide by the rules, and they are they use many measures to collect bad debt, and sometimes they're not lawful. So we need to know what our rights are. You can check with the State Attorney General's office or the Federal Trade Commission. And so they also have accounts in good standing. And so sometimes people talk about the hard inquiries or hard hits and soft hit. This page represents hard inquiries. These are inquiries where the individual has applied for something. They applied for some type of credit product. And so these are hard hits to your credit score, to your credit file. Things like applying for, a credit card and mortgages and auto loans and personal loans. So if you're not sure whether it's a hard hit or a soft hit, and you might want to ask that provider so that they can tell you. And also what I want to say is the occasional hard hits, they're really a small impact on your credit. And sometimes if we are applying for, let's say, a car loan or a mortgage, and we're doing that in a certain small window of time, like maybe 14 to 45 days, those are usually considered like one inquiry. So it depends on the credit scoring model. So this page shows the soft hits. So I mentioned earlier about us looking at our credit, pulling our credit. Whenever I do that, that is a soft inquiry. It is considered a soft inquiry. It does not impact my credit score. So me pulling my credit does not negatively impact my inquiry, impact my credit score. Other types of soft inquiries include an employer that is pulling my credit to offer me a job, insurance companies that's reviewing my credit, unsolicited credit card approvals. Sometimes we get offers from credit card companies wanting to offer us a credit card. I mentioned earlier how the credit bureaus are like data warehouses. So our information is bought and sold. And so they get like a profile of us, and it gives them enough information to let them know whether or not they want to offer us a service, offer us a credit card. Once they do that and I take that off, and now they're really going to pull my credit, do that hard hit. And sometimes people, when they thought they've been pre-approved, once their credit is really pulled, now the offer doesn't stand, because now the company has a full disclosure of all of your information in your credit file, and there's something there that now they don't want to extend that offer to you. And also too, when you already have an account with a lender, they make periodic reviews of our credit files, and that does not negatively impact our credit rating. So this is the last page of the credit report. Here you've got the various ways that this individual has applied for services and loans, how they've used their name. You have John Q Consumer, Jonathan Q Consumer, JQ Consumer, why they use their name, many different ways. There could be any number of reasons. Sometimes we just feel, some days we feel more official, and other days we're tired and we just abbreviate. No matter how you use your name when you are applying for different services, especially when credit is involved, your credit file, your credit history is tracked by your Social Security number. That is the linkage. This also has your date of birth, As if you have a spouse or a co-applicant, your employer, and then all the different places where you've lived. There are many scoring models available when we talk about the credit score. However, according to Fair Isaac and Company, 90% of lenders use the FICO score when they are approving loans. You can get your FICO score from myfico.com. You do have to pay for that. And then also lenders will give you your credit score when you are applying for loans. Other credit and marketing companies will also give it to you for free as well. Like I mentioned earlier, you can go to different sites, you get a free score, but the score could be different. Not all scores are the same because there are different scoring models that is being used by lenders and different organizations. So 90% of companies, lenders use the FICO score. So your credit score could be different because of the scoring model that is being used. It is also, your credit score can also be different because of the information that is in your report. Information in your report is being constantly updated all the time, and your report is only as good as right now today. Sometimes people want to pull their credit report and they want to bring it into a lender to help them get qualified for a loan. Two things wrong with that. First, the report is old. The information is no longer valid. Then also the type of report that you get as a consumer is different from what we get as a lender. We have to use our own credit reports when you come in and you apply for that loan. We're going to pull our own. According to FICO, a score of 670 is considered the baseline for what they call a good score. After that, the rating goes to very good and then exceptional. So you got this 300 up to 850. So 850 would be the exceptional. To have a valid score, an individual must have at least one account open for 6 months. Some people have what's called a thin credit line, or they might not have any type of credit. They might have, some people have what's called a thin credit line, or they don't have any credit at all. That just means that they need to build credit. They haven't had maybe any credit extended to them. They need to get some kind of credit product out there that they can show that they are making some payments every month. So now we're going to talk a little bit more in depth about the credit score and what makes it up. So 35% of what makes up your credit score. So I have an 800 credit score. 35% of what makes up that credit score is my payment history. If I have a 600 credit score, 35% of what makes up that 600 is my payment history. My payment history will include all credit accounts that are paid as agreed, overdue accounts, delinquent payments, bankruptcies, lawsuits, evictions, back child support, wage attachments, garnishments, collections, public records, anything derogatory in my credit will affect my payment history. 30% of what makes up my credit score is amounts owed, and that is how much debt that I carry in total. 15% of what makes up my credit history is my good long-standing accounts. I've had an account with a certain company for probably 15, 20 years that I kind of don't use a lot. It's a credit card account, but I keep that account because I know that 15% of what makes up my credit score is that longevity. So I keep that account. I don't want to close it out. And then 10% is new credit. And the other 10% is the types of credit. So new credit will remain on my credit report for up to 2 years. 10% of my credit score is the mix. So that means credit cards, retail store cards, car loans, mortgages, personal loans. Lenders want to see like a healthy mix. They want to see that I have a good mixture. They don't want to see that the only type of credit I have is all unsecured credit cards. It's good to have a healthy mix. So all of the information in our credit reports is used to analyze and get the credit score. So now let's talk about how to improve your credit. All financial institutions have their own set of lending policies, guidelines, and level of underwriting risks that they're willing to take. There are ways to improve your score, but it does take time. So while one lender may approve a loan, another may deny the loan. It all depends on their guidelines. Making on-time payments to creditors is a way to improve your score. Getting a secure credit card, which means that you are, in essence, investing in yourself. So I'm going to take, for example, $300. I'm going to put it in an account. The lender is going to give me a credit card with a credit line of $300. Now I need to take that card and I need to start to use it. I need to use it and at least get 6 months worth of a payment history so that I can have something positive on my credit report, at least 6 months of a trade. And then pay down revolving loans and credit cards. Sometimes people have a lot of unsecured debt. They have a lot of credit cards, a lot of high balances credit card. Paying those down will help improve your credit score. And then sometimes people just have to stop applying for more credit. Sometimes people think if I could just get this one loan and that will help me to pay off all these other things. Sometimes that's not the answer. If you have a lot of revolving lines of credit and high credit limits, you might have a hard time getting a loan to pay that off because there's no collateral. And then sometimes we have to just say, you know, don't apply for anything else. Don't apply for any other loan. Just work on getting out of debt. And then the last thing that I want to talk about is the pro tip. Co-signing makes you responsible for the loan. Co-signing is something that people do for a number of reasons, a couple of reasons. One, people that don't have credit, sometimes they want somebody to co-sign for them to help them get that jump start to build credit. Then the other reason people want someone to co-sign is because if their account has been damaged, they might they want somebody to help them, somebody that has good credit, to co-sign to help them build credit. Co-signing comes with a risk. It makes you responsible. Anytime you co-sign on a loan, what you're saying is that I have a loan and I'm responsible. Even though that individual is the applicant and I'm the co-applicant or co-borrower, I am responsible. People don't mean to lose their jobs. People don't sign on to loans thinking that I'm going to get this loan, but I'm not going to pay it back. Things happen in life. And when we're co-signing, we just have to remember that I have a loan. If this individual cannot pay for whatever the reason is, I now have a loan and I am responsible for this loan because it will show on my credit. And as amounts owed, it will affect my credit rating, my credit utilization. It will impact my credit. So another way to improve your credit is by signing up for what is called Experian Boost, B-O-O-S-T. It is a free service that is offered by Experian. You can sign up on their website and it lets consumers opt in to include a cell phone or a utility bill into the calculation of their credit score using data from Experian. Boost will only count positive payments. So if you miss a payment with a utility company, it's not going to count that. This is intended to help individuals rebuild and build credit. Actions that might hurt your score: missing payments, maxing out credit cards, closing out cards, applying for credit excessively, having more revolving loans in relations to installment loans. So loans that are or loan payments that are 30 days or more late gets reported to the credit bureaus as a late payment. And those will show up on your credit report for up to 2 years. So when you pull your report, you're going to see for the last 2 years your payment history. Bills that have been reported to collection companies that have not been paid will show on your credit file for up to 7 years. Bankruptcies can show up to 10 years. Remember that there is that statute of limitations on certain types of debt. Um, Good debt follow you forever. Some debt will fall off after 7 years, some after 10 years, and it really just depends. A good source to find out more information about those will be the Federal Trade Commission. And then you can also go to your state attorney general's office to get information as well. So you've got your report. What is the next step? You pulled your credit report. Now what do you do? Well, you can dispute anything on your report that might be wrong, inaccurate information. If there's something wrong in your report, you can do it online depending on the severity or the complexity of that. If it is complex, identity theft, I need to send in proof with documentation. I'm going to keep a copy of my letter. I'm going to keep a copy of everything that I sent to the credit bureaus, and I want to do it certified mail. And I can also add a statement to my file if I'm disputing something. I can put a fraud alert if that's the case as well. I can also freeze my report. I can freeze my report. And so what that means is that no one can apply for any kind of credit in my name. It also means that I won't be able to apply for any kind of credit product if I have this freeze. I can freeze it on all three of the credit bureaus. With all three of the credit bureaus, I can freeze it and I can unfreeze it. Freezing your report does not impact you in a way where if you're looking for a job that they won't be able to see your report, they still can. Or if you're renting an apartment, you might want to ask, when you're doing that, but it usually will not impact you and there is no cost. Then the last thing is opt-out pre-screen. Sometimes we get credit card solicitation from companies that we don't even have an account with. They buy our information. I can go to opt-out pre-screen and I can request that my name, my phone number, my information is not used, is not given to companies so that they can offer me credit card offers. You can do it for up to 5 years or up to the rest of your life. And I believe when I did it forever. Like, I don't want any more solicitations from companies offering me a credit card. So these are snippets of 3 handouts that will be available to you that can help you create an action plan. So you pull your credit, now what? Some of us might have goals, things that we want to take care of. We might want to get out of debt. Personally, I am the individual that firmly believe that we don't have to be in debt for the rest of our lives. The first handout, tool 1, says it's a debt worksheet, knowing what you owe. This is a worksheet that will help you to organize your information in a way so that you can see what you owe. So once you've gotten you've pulled your credit report, you're looking at it, you've got all this information, you can organize this information in a way so that you can see who you owe, how much, what the payments are, the annual percentage rate, and then you can come up with a plan on how you're going to pay these things off. And then the second one is, what is your debt to income ratio? Lenders use this all the time. These handouts came from the Consumer Financial Protection Bureau. So you can run your own numbers. There's a section for if you are a renter or if you are a home owner. So the numbers are going to be different. So you can run your own numbers to let you see what your income to debt ratio is. So when you are applying for loans, besides looking at your credit, looking at your application, lenders run the number. They want to know if you can take on another loan, another payment, another debt, another bill. And then the third one is the debt reduction worksheet, which is my favorite because it helps you figure out how to get out of debt. You put the lender's name, the amount owed, you can organize it, and then you can come up with an action plan depending on where you are in your financial life, where you are in your finances, what are your goals, what are you trying to accomplish. And the next thing that I'm going to show you is a video that illustrates how the power pay principle works to get out of debt. So here we go.
Debt can be overwhelming. It can hang over your head like a cloud, always threatening to bury you in the snow. But luckily, if you're in debt, you have a friend. Meet Abe. Most people know him as the abominable snowman, but he prefers Abe. Abe knows a couple of ways to get out of debt: the snowball method and the avalanche method. The snowball method helps if you're too overwhelmed to even start. List out all your debts in order of smallest balance to largest balance. Start by focusing on the smallest balance, regardless of interest rate. Pay as much as you can on this debt, while paying the minimum on all the others. Once the smallest debt is gone, move on to the next one. Keep paying the minimum on all your other debts, while paying as much as you can on your smallest remaining balance. This snowballing method will help you build momentum, since you can see quick results right away. The avalanche method is much more aggressive, but can be very daunting since you won't necessarily see results right away. This time, list your debts from smallest to largest interest rate, regardless of balance. Pay as much as you can on the debt with the highest interest rate, while paying the minimum on everything else. Once that debt is gone, move on to the next one, and so on, until your debt is gone. This avalanching method ultimately saves you the most money, because you're paying off the highest interest rates first. So if you feel too overwhelmed and don't know where to begin, use the snowball method. Start small, build some confidence, and go from there. If you just want to dive in as aggressively as possible, use the avalanche method. This will ultimately save you the most money. But the important thing to remember in paying off debt is that you can't give up. No matter what way you choose, the key is to find a method that will help you stay the course until the end.
So that is my favorite video because I don't believe in being in debt for the entirety of your life. Debt is good for a period of time, but to be in debt for your entire life, I just don't believe in that. It gives you financial freedom when you don't have those bills and those debts. All right, so this slide will show some examples of alternative credit that some people use that are very expensive. Payday loans, rent-a-centers, title loans. Even though in Arizona, payday loans have been outlawed, they are still here, but they're under a different type of name. They're kind of restructured, but the concept is still the same. They're not good loans. They're very expensive. By the time an individual gets through renting that furniture, the appliance, the TV, they could have paid for it 3 times over. It is very expensive. And then also in many of our neighborhoods, we have title loan stores. They are all over. A lot of them are in certain neighborhoods, and these are really expensive ways to get credit. And so the Consumer Federation of America is a nonprofit organization, a nonprofit research organization that compiled this information that you see on your screen. It is representative of how title loans work. Very different from loans that you get from a regular financial institution. The rates are based on a monthly interest rate where financial institutions have an annual percentage rate. So you look at this loan, you've got a $2,500 loan over a 24-month period of time. The monthly rate is 17%. When you take that monthly rate and you convert it to a regular annual percentage rate, that banks and credit unions use, it becomes a 204% rate. That is a very expensive loan. So a person gets this type of loan when they go to make the very first payment. The payment is $435. Of that $435, only $10 goes toward the principal. Interest gets paid first, and interest on loans accrue daily. This is a bad loan. And a lot of times what happens is, because this is a bad loan, people are in distress to get this loan for whatever the situation is. In 30 days, more than likely things haven't turned around. So they go in, can't really make the payment. The company will offer to refinance. So now you're digging yourself a deeper hole. I think the Center for Responsible Lending did a study some years ago that said that people that get this loan on average, they get it refinanced on average 8 times. 8 times of getting that same loan refinanced. So you're digging yourself a deeper hole. It doesn't get better, it just gets worse. So this advertisement for clean credit has been posted throughout Phoenix for several years. This is actually a scam that claims to clean your credit, but what they really do is take money up front and promise to remove negative information. However, if the information is true, if it is accurate, on your report, it might come off for a short period of time while it's being disputed, but if it's legitimate, it's going to be right back on your report. I called this number because I really wanted to know, how are you doing this? How can you do this? They know the law. They know the Fair Credit Reporting law. They know what the law is. They quote it. They're very good. They're fast talkers. And they know that the credit bureaus have 30 days to investigate disputes. And so that's where this 30-day window of a guarantee comes in. Why couldn't it not be 6 months or 1 year? 30 days, because they know what the law says. And so after 30 days, if it is yours and the information is accurate, it's going to be right back on your report. In the classes that I teach in the community, I cannot tell you how many people that I have spoken with who have shared how they paid some company, a few $100s to clean up their credit, and a few months later, the information was right back on their credit report. On this particular advertisement, because I called, they were charging $675, and they told me that because I called today, and they took a credit card, which I thought was odd, because I called today, they would give me $100 off. They are companies that take advantage of people. Scams, even if they have a nice building, it could still be a scam. It sounds like it's too good to be true. More than likely, it is too good to be true. But if you need help, there are credible non-profit organizations that are out there that can help give direction, help provide counseling, coaching, help put you on a budget, a spending plan that can help consumers achieve financial stability. Repairing credit takes time, it takes money, and it takes patience. You can't be in a hurry. And that is what sometimes get people into trouble, because they're in a hurry to get that thing, to get that car, to get that house. They don't want to go through that whole process of taking their time and making sure that everything is done correctly. And, they're going through that whole process and they're in a good place. There are many different nonprofit organizations that are out there willing to help you. And so they're going to ask for your budget. They're going to ask you about your spending plan. They're going to ask you about your goals. And so it takes time. There's no silver bullet. There's nothing quick about cleaning up your credit. It takes time. And so I just want to thank you for watching this webinar, for participating. I hope that the information that I shared was helpful. that is beneficial and that it'll help you to achieve whatever your goals are to get into the driver's seat of your finances. Thank you so much, and I hope you have a great rest of your day. Thank you.